Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video, we're going to be talking about 6 high quality dividend stock in healthcare sector that have been paying their dividend and increasing it anywhere between 6 years to all the way to 59 years. These 6 high quality healthcare stocks are currently considered to be undervalued or reasonably valued and are remarkable choices for dividend stock investors. Without any further ado, let's get into it. All right, our very first pick is a company no other than Gilead Sciences, with ticker symbol GILD. This biopharmaceutical company has a market cap of $72.9 billion, making it a large cap size company. It is currently considered to be undervalued and has a dividend yield of 5% plus, slightly over 5%. From a price to earnings ratio, we are looking at a multiple of 9, which is below 5-year average for Gilead Sciences. The dividend safety score for Gilead Sciences is also at 70, making it a safe dividend pair. Looking at the dividend growth streak for Gilead Sciences, they have increased their dividend for the past 6 years, and they currently do pay their dividend on a quarterly basis. These dividends are paid in the months of March, June, September, and December. The payout ratio for Gilead Sciences dividends is at 39%, which edges slightly higher for that of biotechs, and nonetheless, it is within the acceptable range when it comes to the payout ratio. From a free cash flow perspective, Gilead Sciences is showing positive free cash flow in each of the last 10 years, which is quite decent. We don't have any track record for their dividend performance during their recession years because their company was not paying a dividend during the recession of 2007 to 2009. Looking at the past performance of Gilead Sciences, in the past 1 year, the stock is shown to be down by 7.53%, but in the past 5 years, it is down by close to 15%. Our second pick is Cardinal Health, with ticker symbol CAH. It has a market cap of $14.6 billion, making it a large cap size company. Cardinal Health is currently looks to be reasonably valued, and it has a dividend yield of 3.64%. The price to earnings ratio for Cardinal Health is at 9.8, which is in line with their own 5-year average. Dividend safety score for Cardinal Health is at 74, marking it as a safe dividend pair. The company has been increasing its dividends for the past 37 years straight, remarkable, and they have a frequency of dividend payments, which is quarterly. This dividend is paid in the months of January, April, July, and October. The payout ratio for Cardinal Health is at 40%, which is considered low for healthcare distributors. From a free cash flow perspective, they are also showing a positive free cash flow in all of the last 10 years. It's worthwhile mentioning that Cardinal Health increased its dividend, continued to increase its dividend during the recession years of 2007 to 2009. The stock past performance for Cardinal Health is showing to be negative 7% for the past 1 year, and in the past 5 years, it is down by over 35%. A huge decline for the stock in the past 5 years. Next on our list, we have Merck. It is a company in healthcare operating as a healthcare company worldwide and has $197 billion in market cap, making it a mega cap company. It is considered to be undervalued at this time and has a dividend yield of 3.51%. The price to earnings ratio for Merck is at 10.9, which is below their own 5-year average. Merck has a dividend safety score of 99, making it a very safe dividend paying company. They have increased their dividend year after year for the past 10 years. Merck also pays its dividends on a quarterly basis, and it's paid in the months of January, April, July, and October. The payout ratio for Merck is at 42%, which is considered to be overall low for most companies. They are showing to be positive free cash flow in the past 10 years in all of those years. During the recession years of 2007 and 2009, Merck did not increase its dividend, nor did it cut it. In fact, they did maintain their dividend during those years at the same level that they were before. Looking at the past stock performance for Merck, the ticker symbol MRK, the past 1 year, the stock is shown to be up by 3.16%, and in the past 5 years, it is up by 21.55%. Our next pick is Amgen, the ticker symbol AMGN. This company has a market cap of $128 billion, making it another mega cap sized company. It is considered to be undervalued at this time and has a dividend yield of 3.35%. The price to earnings ratio for Amgen is at 13.2, which is in line with their own 5-year average. Dividend safety score for Amgen is at 74, making it a safe dividend payer, and it also has increased its dividend for the past 10 years. Amgen does pay its dividend quarterly, and the dividend is paid in the months of March, June, September, and December. The payout ratio for Amgen is at 41%, which edges higher for biotech company. Amgen is showing positive free cash flow in each of the last 10 years, and during the recession years of 2007-2009, they were not paying their dividend. They were not dividend paying at the time, and hence we don't have any data related to any changes in terms of increase or decrease of dividend amounts during those years. Looking at the past performance of Amgen, in the past 1 year, the stock is down by about 1.84%. And in the past 5 years, it is showing a positive return of 26.8%. Our next pick is Bristol-Myers, with ticker symbol BMY. It has a market cap of $151 billion, making it a mega cap company. It looks to be reasonably valued at this time and has a dividend yield of 3.10%. The price to earnings ratio for Bristol-Myers is at 9, which is below 5-year average of this same company. Their dividend safety score is at 79, which is considered to be a safe dividend payer, and they have increased their dividend year after year for the past 15 years. Bristol-Myers does pay its dividend quarterly in the months of February, May, August, and November. Their payout ratio is at 27%, which is considered low for biotechs, leaving them a ton of room to increase their dividends for years to come. Bristol-Myers is showing positive free cash flow in each of the last 10 years, and during the recession years of 2007-2009, they maintained their dividend at the same level prior to the recession. Looking at the past stock performance for Bristol-Myers, the past 1 year, the stock is up by 13.6%, and the past 5 years, the stock is up by close to 21%. Lastly, our sixth pick is a renowned company, no other than Johnson & Johnson, the ticker symbol JNJ. They have a market cap of $451 billion, making them a mega cap size company, and the highest market cap among these 6 healthcare companies that we've talked about so far. Johnson & Johnson is appearing to be reasonably valued at this time, and it has the lowest dividend yield compared to the other stocks that we've talked so far at 2.41% currently. Their price to earnings ratio is at 16.8, which is in line with their own 5-year average. The dividend safety score for Johnson & Johnson is at 99, making them a very safe dividend payer. Look at the dividend growth streak for Johnson & Johnson, a massive, remarkable 59 years. They've increased their dividend uninterrupted and consecutively for the past 59 years, making them a dividend king. Payment frequency for their dividends is quarterly as well. Their dividends are paid in the months of March, June, September, and December. The payout ratio for Johnson & Johnson's dividend is currently at 43%, which is considered low for most companies. And they also show a positive free cash flow in each of the last 10 years. Johnson & Johnson has also increased its dividend during the recession years of 2007-2009, which can be attested to by the fact that they've increased their dividend for the past 59 years. Looking at the past performance of Johnson & Johnson, their 1-year return is at positive 9.8%, close to 10%, and the past 5-year return, they're up by 36.6%, which is incredible and remarkable. There you have it, folks. A quick look into 6 high-quality healthcare dividend-paying stocks that have been paying their dividend reliably for many years, and they've increased it anywhere between the past 6 years all the way to past 59 years. These companies are currently considered to be undervalued or reasonably valued at this time and might be wonderful picks for dividend stock investors. I would love to hear from you and know whether you are currently invested in any healthcare dividend stock. And if you are, leave us a comment down below and share the ticker or the name of the company that you are invested in the healthcare sector. And we would love to hear from you. We hope you found this video beneficial and gained something of value from it. If you did, Don't forget to smash that like button and share this video with someone else who might benefit from it as well. Of course, subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing, whether it's investing in the dividend stocks, growth stocks, as well as penny stocks. And we also talk about investing in real estate and cryptocurrencies, as well as discussing ways to reach financial freedom. Thank you, and I hope to see you next time.